All right, hi guys, welcome back to another session of this very beautiful subject SBR. And today is going to be one of the most important classes. This is one of the most important session because today we are starting with revenue. All right, write it very important and also very easy. Trust me, this is one of the most easiest, most wonderful accounting standard IFRS, most beautiful IFRS that we are going to go through. This is one of the most widely used. See, any kind of business, there are chances that a business may have no asset or very minimal asset, let's say property, plant and equipment, very minimal assets, but no business can survive without revenue. All right, revenue is the lifeblood for any business, so any industry you choose to work in. All right, this very IFRS is required in each and every kind of industry. You can understand the importance of what revenue is. Okay, and as I told you in earlier lectures, I shall be using Kaplan's study material for discussion. If you have this, very nice. If you don't have this, no worries. All the study materials are more or less the same. The concepts remain the same. And see, it depends from chapter to chapter that how, which approach we need to follow. How do we, go about it? So this being a very technical and important chapter, we shall be discussing with the study text initially. All right, because this is a learning phase. We are learning it right now. And then I have made a very, comprehensive yet concise summary, 1 or 2 page summary, which we shall be discussing towards the end of this IFRS. Once we are done with the technical concepts, once we are done with learning, then only we shall be moving towards summary part. Okay, so don't worry, I shall be giving you a very nice, very crisp summary, but then that is after learning, the technical details of this chapter. And this approach shall be changing from chapter to chapter. Like in previous chapter, we just went through the comprehensive summaries. Now this is being more technical in nature. We shall be going through study text. So the approach changes from chapter to chapter. All right. So now let us get started. What do you mean by revenue? If I ask you in a very layman language, I know you all have cleared your previous levels of exam. You are a very smart and knowledgeable people of accounts. But let's just think from a layman's perspective. All right. What is revenue? In a layman language, I can say earnings. All right, it's my earning, it's my cash inflow. It's my cash inflow. That's how I'm supposed to run my business. All right. Now let's try to make it, professional. Now let's try to make it an expert definition, slowly, word by word. Is earning word enough, or it should be earning from normal operations of business? Normal operation. Now this is a key word here. Normal operations. See how. If I sell an asset, if the company for which I'm working, or the firm for which I'm working, or the entity, whatever, for which I'm working, if they sell their asset, is that a revenue? See, that's a cash inflow. But is that a revenue? Of course not. That's not a revenue. Why? Because we don't sell asset in normal day-to-day operations. Now, for instance, you are working in a firm, in an ACCA firm, in an accountant firm, in a taxation firm, whatever. So the firm has computers, laptops. All right. This is your laptop and this is your graph which you are discussing. Wow, isn't it a good drawing? Okay, so this laptop is an asset for your firm because you render services through this. It's a property plant and equipment. All right. Now, if you sell this particular laptop for any reason, it has become outdated, or what, for any reason, or the number of laptops required have reduced now, you sell this and you get some money. You get, let's say you get $10. Is this $10 a revenue? That's my question. Of course not, right? Because this is not normal operations of the firm. What are the normal operations of the firm? To render auditing, accounting, taxation, advisory, merger and acquisition services to the client. If it's a firm, a tax firm, let's just say, it's of course not its normal operation. But on the contrary, if the same laptop is sold by HP, all right, I myself use an HP laptop, so that's why I'm taking this name. Now, if the same laptop is sold by HP, now what's their line of business? They are into this. Selling laptops is their day-to-day business. It's their normal operation. So for them, it will be revenue. All right. It's not enough just that any cash inflow can be recognized as revenue. It has to be the day-to-day business operation. All right. Okay. Now, you know, this very standard IFRS, this very IFRS, or you know, there are like different gaps as we have studied. There are US GAAP, then there is IFRS, and then there are country-specific gaps such as Ind AS in India, US GAAP in United States, IFRS in European countries, so on and so forth. But then this 5-step approach model of revenue recognition, be it any of the major gaps worldwide, the revenue recognition process is moving towards this 5 approach step. All right, this is a very important 5-step approach which we shall be learning in next 10 to 15 minutes. Now, earlier, if you go through the text of the earlier accounting standards, though there is no requirement of going through it, just for the sake of discussion, revenue was recognized when the risk and reward used to get transferred. Risk, this is I'm talking about earlier days, risk and reward used to get transferred. That's it. The only major point of recognizing a revenue in books of accounts was as soon as risk and reward gets transferred, as soon as we establish the fact that risk and reward is getting transferred, we used to recognize revenue. But now this has moved to a 5-step approach, which we shall be studying here. All right. See, the discussion I told you. Revenue is income arising in course of entities' ordinary activities. This was a discussion we were having just right now. All right. It's very important to write this word. This is an operative word. Ordinary activity means normal trading or operating activities. Now this depends from entity to entity, business to business, circumstances to circumstances. All right. If there is a real estate company, a real estate firm, a real estate business, for it, plots, house, what else, penthouse, whatever, all these things are selling, all these things are their day-to-day operation. Day-to-day operation, that's what their operating ordinary activities are. So for them, any inflow coming through this is revenue. Any income coming from selling this, plots and houses, etc., is revenue. On the contrary, if the business is in some other line, be it a tax advisory, be it laptop production, be it any other business, for them, plots and offices and houses on all the real estate stuff is property, plant and equipment. So there is no thumb rule. All right, there is no thumb rule, absolutely no thumb rule to determine that what is a revenue and you know what is your inventory and what is your asset. You earn revenue by selling your inventory by, okay, write this. Let me just delete this. How do you earn revenue? Write this point. Write it down on a sticky note, as I have told you quite a few times to start using sticky notes. Revenue is earned by rendering services and selling inventory. All right, the word is inventory. What is inventory? Inventory are, you can write it like this: goods being sold in ordinary circumstances. Ordinary, or okay, just let me, if you haven't written yet, let me just modify it. Day-to-day activity. All right, this is what inventory is. If any non-current asset or fixed asset or property, plant and equipment, these are different names. If any non-current asset, fixed asset or property, plant, equipment is sold, that is not revenue. Not revenue. All right, that is not revenue. Write it down and stick it somewhere in your study text. Okay, see, I haven't read this right now, but then the same thing is written here, so you can just highlight it as well. Okay, now you can go through this if you want in your study text. This is not something worth discussing in the class. This is the history and you know certain stuff. You are supposed to go through it. All right, if I'm skipping something because that is not worth discussion in class. The lectures are meant to discuss relevant things, all right, which make impact. But for you, for your self-study purpose, every word written in book is relevant. All right, so if I say that this is not relevant, this particular thing is not relevant, that's for the sake of discussion in lectures. But then if you want to form an opinion, as I've told you in earlier, the first lecture, I guess, that there will be a question which will ask you for opinion. For opinion, you need thought process. What do you need? You need a thought process. You need a knowledge bank inside your brain, which can be only developed if you read the text. Okay. Now this is it. The most famous, the most comprehensive revenue recognition setup. This is 60%. Or in fact more than that, 60 to 80% of your chapter is within these 5 points. That's it. That's it. It's a 5-step process to recognize revenue. How do you come to a decision that okay, this is revenue? How do you account in it books? How do you, at what value do you account it in your books? When do you account it in your books? Is all in this. Okay, all right. So let us just go through it. IFRS 15 revenue recognition from contract with customers says that an entity recognizes revenue by applying the following 5 steps. Identify the contract. Okay, just go through it, just read, and then I shall be discussing it in detail. Identify the separate performance obligation. Now this very word, performance obligation, you have to use this n number of times, probably every time when you write an answer for revenue recognition. The concept of recognizing revenue is around this very thing of performance obligation. All right. Performance obligation means promises. What all you are supposed to deliver. Is it a good? Is it a service? Is it both? How many services? How many goods? Promises to be fulfilled. These are not your personal life promises. These are corporate technical promises. All right. These are the promise to deliver a good, to deliver a service in a set span of time, to deliver a combination of service, a combination of goods, or a combination of goods and services. All right. This can be any promise within the scope of your business activities. Now you shall get paid for it. If you fulfill a promise, all right, you shall be getting paid for it, right? That's how business run. The amount that you have to, recognize in books of accounts, or the amount that you have to kind of know that is the amount that you are getting for fulfilling a particular promise, is called transaction price. Now you have to determine a transaction price. Now, first of all, don't get afraid that how will you learn all these 5 steps. In next 10-15 minutes, it will be on your tips, right? The first and foremost thing is that you have to trust your trainer. So relax, don't get worried. How will you learn this, or how am I going to understand this? Just listen to me, okay? That's it. Do what I tell you to do and do not worry about anything else, okay? Now, once you know the transaction price, see, read the 4th point. Allocate the transaction price to the performance obligation. See, here the word uses performance obligations. All right, let me give you an example. So you buy a brand new car. You all have qualified as ACCAs. All right, very soon you will be qualifying, and then you will join a good company or start your own consultancy or whatever your business. And then you will earn fat paychecks, and then you will buy a brand new car. All this will happen very soon. All right. You buy a brand new car. Which one? Okay, a BMW. You buy a BMW. You go to their showroom. You buy a BMW for worth, let's say, what's the price in that currency? Let's just say $85,000. All right. It's a wild guess because I am used to Indian currency of BMW, and we don't think of buying BMW that often. Anyways, let it be $85,000. Now, what do you get here is a car and a 5-year service. You are paying $85,000 for a car and a 5-year of service. Now, what is a car here? It's a good. What is a 5-year service? It's a service, of course. Now, ain't these two things separate promises? Ain't these two things separate performance obligations? The keys of the car are handed over to you. That's it. Now you are the owner of the car. This performance obligation of handling over the car is done. But is this performance obligation fulfilled? No, this will get fulfilled with passage of time because this is a 5-year promise. The promise to service your car holds valid for 5 years. So these are two separate performance obligations. Ain't they? Alright. Now, okay, so there are many students listening to this lecture. One of the students bought a brand new car and another student of mine was working as an accountant here, as a financial reporter here in BMW. Now, how will this $85,000 will be allocated to separate performance obligations? One being good, another being service. You have received 85 plus BMW has received $85,000 as one amount, right? The Customer paying it does not know what is for car, what is for service. All right, it's a deal that pay us $85,000, get a brand new car, and get a 5 years of service agreement. Now, being an accountant in BMW, you are supposed to record these two different promises separately, because one is getting fulfilled, this one is getting fulfilled right there, while the 5-year service will take 5 years time to get fulfilled. So these are two different promises, these are two different performance obligations. So accordingly this $85,000 will get allocated between these two performance obligations. All right, okay, this is what this point says. Allocate the transaction price to the performance obligation in the contract. Do you get this? And then recognize the revenue when performance obligation is satisfied. Now, same example. See, the car was handed over, then and there it was handed over. So the performance obligation of handing over the car was satisfied. This promise was satisfied. So now you can recognize the revenue pertaining to this performance obligation of car in your books of accounts. Handed over, excuse me. Yeah. All right. Once the car is delivered, once the keys are handed over, the performance obligation of delivering a car is completed. So you can recognize the revenue pertaining to this particular performance obligation, this one. But this 5 years of service, this will get completed eventually with passage of time. So the revenue for this would be recognized with passage of time. Revenue would be recognized with passage of time. On the contrary, here the revenue is recognized point in time. As soon as the keys are handed over, the vehicle is handed over, performance obligation is done. However, here it is over time. Now these two words, though you don't need to write them right now, anything if that needs to be written will be informed you, so no need to write this. Okay. Now these are two technical terms which we shall be studying later in this chapter. So a performance obligation can be satisfied in only two manners. One is overtime, that is then and there at particular point of time, like handing over a car, like handing over a machinery, like handing over any good. All right. Or it can take passage of time. It can be satisfied over a period of time, as in the case of 5 years of service. So we need to separate. First of all, we need to allocate. We need to allocate this $85,000 according to performance obligation, and then recognize them separately as soon as it gets satisfied. All right. Now, if you want to write down this example or story anywhere, you can. If you want to, just pause the video and write it down. Okay, I've given this good explanation on the screen. Just pause it or take a screenshot or whatever you are tech savvy, guys. Now I am deleting this, okay, because I need to do another discussion. Let me clean this off. I hope you are following my strategies of reading the text just after watching the lecture. And if you are binge watching these lectures, this ain't a web series on Netflix or Amazon Prime. You need to watch it with full focus. So take a 5 to 10 minutes rest while you jump from one lecture to another lecture, but make sure that the rest does not last more than 15 minutes. All right. And don't open a YouTube video or any such thing which sucks energy from you even further. Just close your eyes and take a deep breathe and relax. That's how you relax. Don't relax by watching YouTube videos. Okay. So now let's just come back to the point. See how to learn these 5 steps. The first one is identify the contract. Okay, I told you another technique of mnemonic codes, didn't I? So we shall be applying that here as well. How do we do that? We look for the operating words and then we design a code accordingly. So here, what's the word? What's the operating word in first point? It's of course the contract. All right. You need to know the contract. So C for contract. Identify the separate performance obligation. What are different promises? What are different things? What are different goods, different services, combinations that you have promised, that you are obliged to perform as per a contract? The operative word here is performance obligation. P. All right. Okay. Determine the transaction price. Now you need to determine what are you going to get paid for it. CPP, transaction price. Okay. Now allocate the transaction price to performance obligation. What is the keyword here? Allocation. See, if you go through these steps, see, these steps are going like this and then this and then this. See, I'll tell you how. Allocate the transaction price. Now what is transaction price? The third point. To the performance obligation. What is the performance obligation? The second point. In the contract. What is the first point? The contract. This is third point. This is second point. This is first point. Many people find it tough to, recall the fourth point because they mug up. There is a difference between learning and mugging up. Mugging up is just trying to fix it in your brain without any logic. Now, if you try to reread this with this logic that this point is going backwards. Now, once you have determined the transaction price, you need to allocate the transaction price to the performance obligation in the contract. See, that's how it is. Allocate the transaction price to the performance obligations in the contract. So the operative word here is allocation. You need to divide the transaction price between a car and a service agreement. Okay. And then recognize the revenue. So the code becomes CPPAR captor. See, since I'm from India, in our chartered accountancy examinations, which are parallel to ACCA, the foundation exams, the first level exams are called CPT. So it becomes relatively easier here. CPT is the name of the exam, which is Common Proficiency Test, and AR becomes accounts receivable. You can, term this as Captain AR, Captain Accounts Receivable, Captar, or whatever. All right, Captain AR suits, or Captar, or CPT AR, whatever you want to. Now, C stands for, now let me hide this. All right, you shall be repeating with me. See, you can fool this by looking in the book, but in that case, you aren't fooling me or fooling yourself. Don't look in the book. Do not look in the book because we are here to learn. You shall not be carrying the book in your exams, right? This is not an open book examination. So don't look in the book. Try to recall it. The code is CPPAR, Captain AR, Captar, whatever you want to pronounce it. C stands for contract. What was the point? See, this is another way of taking a thing from your short-term memory to long-term memory. Write it down on a rough paper. Write it down on a rough paper then and there. So the points get established in your brain. Okay, contract. What was the point? Identify the contract. Okay. The next thing is P. P stands for performance obligation. Identify the performance obligation in what? In the contract. See, there is a reference to the previous point in every succeeding point. What's the next code? T. T stands for transaction price. Don't be afraid if you can't recall it here, if you can recall something partly, something not. You are in the learning phase. I am the faculty, I am the trainer, so I'm bound to know this by heart. But if you can't recall it, don't worry. Just try to recall it. Alright? What I'm asking you is your effort to recall. That's it. If you can't, that's my job how to make sure that you remember this. But try recalling it. Transaction price. Okay, so now what's the point? Now you have to see, determine. The word is not identified. Determine. Determine the transaction price. A. A stands for allocation. Allocate. Now what will you allocate? You will allocate the transaction price. To what? To performance obligations. As per what? As per contract. That's it. Allocate the transaction price to performance obligation as per contract. What was the last point? R. R stands for revenue or recognize revenue. Whatever suits you. Now, recognize revenue. Now, I don't recall the exact line. Okay, even being a faculty, even being a trainer, see, it's not mugging up, it's learning. When do you recognize revenue? When the performance obligation gets satisfied. Now the words are not same. When the performance obligation is satisfied. Now what's the exact line? Recognize revenue when performance. Okay, it's the same line. I thought I'm not able to recall the same line, but see, to be very honest, I'm not faking this. I made this line on the basis of concept. I could not recall the exact line and it came out to be exact line. This is what the difference between learning and cramming is. There is nothing wrong in learning. What's wrong is in cramming. Now you get these 5 points. C, T, T, A, R. C. I'll tell you another way of learning a thing. You learn a thing always in much more detail when you teach it. So don't start teaching now. Once the lecture gets over, you need a 5, 10, 15 minutes of resting time to calm your brain. Imagine that you are teaching this to your friend. The summary in 15 minutes of the entire 1.5, 2 hours lecture, you have to just, summarize it in 15 minutes and teach to your friend, imaginary friend in the room. Alright, you may look like a psychotic in this case, don't get worried. Tell your parents this is one of the learning techniques. Teach it. Imagine that you are teaching. So you recall it from a teaching point of view, it gets stuck in your brain, it gets established in your brain. Okay. The words were CPT Captain AR. This is a 5-step model which we shall be applying practically to determine that what a contract is, how to determine a performance obligation, how do we know what is a separate promise and what is not a separate promise. Always write a word. What do you mean by performance obligation? Separate promise. Something which has the capacity of being delivered separately. Now in our example of that BMW car and a service contract, can't that dealership, can't that BMW sell the service contract separately? Of course they can. People do buy it. Alright. And even at the time of, purchasing a car, you are given an option that whether you want to buy it with a separate this agreement of service or no. So a separate promise, a performance obligation means a separate promise. Okay, transaction price is what all benefits, what all monetary stuff or non-monetary stuff, what all things form part of transaction price. What all are you getting to deliver this promise, to deliver this performance obligation? You allocate this transaction price, to performance obligation as per contract. See, and then you recognize the revenue eventually in your books of accounts. Okay, so this is how the 5-step model is. All right, let us go through this illustration. This is a comprehensive illustration which talks about all the 5 steps. So let us go through it. Just a second. Yeah, read along. On December 1 December, whatever the year is, 2001, let's just take this 2011 for convenience. 2011, Wade receives an order from a customer. Wade is the one who has to perform an obligation. Performance obligation has to be done by Wade because he has received an order from a customer for a computer as well as 12 months of technical support. The smart students will get this, and all my students are smart, so every student will get this. All right, they are asking for a computer, the customer is asking for a computer as well as a 12-month of technical support. Now can you sense that there are two promises, two separate promises, two performance obligations in this? All right, very good. Wade delivers the computer to the customer on the same day. What do we call this? We call this, try to recall, point in time. At that point in time, the customer is handed over the computer. Okay, the customer paid $420 upfront. Okay, if sold individually, the selling price of the computer is $300 and that of a technical support is $120. All right, now what is required? Apply the 5 stages of revenue recognition as per IFRS 15 to determine how much revenue Wade should recognize in the year ended on 31st December 2011. All right, so we shall not be going to the answer directly. First I shall expect, see, you can go to the answer if you want. I don't want you to do that. Now it's up to you whether you want to listen to me or not. Don't jump to the answer. Try to apply logics on your own first. Now we shall do this practically right now, right here. What was the first point that we learned? See, this is how you have to write answer. It's all practical. People who say, you know, that this SBR is not a practical subject, God help them. This is a very practical subject. Now we have to apply these principles that we learned just now to answer this question, and we shall be doing that. See how? First point is C for contract. Now we shall be writing this. Step 1, identify the contract. You will write, and then you will write, so the contract is to deliver. What is the contract? To deliver a computer and a 12 months of technical support. Super cool. All right, this is what the contract is. Okay, the next point is P. P stands for performance obligation. Now what's the performance obligation here? It's a computer, one promise, and a technical support, another promise. All right, its technical support is another separate promise in that case. So these are two performance obligations. Transaction price, T stands for transaction price. Now what is the transaction price here? The customer paid $420 upfront. Now what is the use of this information then? I shall be discussing this, don't worry. This information and this information, what is the use of this $300 and $120? We shall be discussing this. But what is the amount that the customer is paying? $420. So the transaction price is exactly, it's $420. CPTAR. A stands for allocate what? Allocate the transaction price to what? To performance obligation on the basis of what? Contract. All right, allocate. Now we shall be allocating this $420 to this performance obligation and this performance obligation. Now how do we allocate this? We allocate this on the basis of standalone price. Standalone price. Now here in this example, see what's the total of standalone price? $300 is standalone price for computer, $120 is standalone price for technical support. Now if we add this, what do we get? We get again $420. Now here the total of standalone price and the price that is being quoted, for the bundled goods and service is same. But more often than not in the real world, see this is an example for the sake of developing understanding. But more often than not, if you buy two things together, you are bound to get a discount, right? So more often than not in a practical world, the standalone price will be of course higher. The total of standalone price will of course be much more than the bundled service and goods, right? So here it's very easy for us to allocate this $420 in the ratio of $300 to $120. All right, because that's what the amount will be. $300 for computer, $300 for computer, and $120 for technical support, because that's what their standalone price is. Now just for the sake of understanding, just a second, just let me clean it a bit. Yeah. Now for the sake of understanding, let this be $320 and let this be $140, because prima facie in a practical world, more often than not, standalone price is much more than the bundled price. Now what we shall be doing? Of course you are smart kids, I know that. You shall be allocating this transaction price in this ratio of $320 is to $140 or 32 is to 40. All right, or 16 is to 7, the ratio. What you shall be doing is, you're getting this? As simple as that. $420 into $320 is the standalone price of computer. And what's the total of standalone price? $320 plus $140 becomes $460. All right, 0, 0, 0. Let's just do this here. This becomes 16. This becomes what? 23. Any more chances? Are there any more chances of anything? No. Let us just do the calculation. Let me get my calculator. 42 into 16 divided by 23. This becomes, excuse me, what wrong am I doing this? Excuse me. Oh yeah, I cancelled a extra zero here, so this becomes 292 point something, $17. So 10 should have stayed here, so it becomes 160. Now the answer is coming right. Okay, so now this becomes the transaction price for computer. That is how you are allocating, and the remaining will go to C. If this is what the price is being allocated, if this price is being allocated to computer, and total that you are getting paid is $420. All right, total you are getting paid is $420. $292.17 belongs to computer. So what amount should be allocated to technical support? The remaining, which is $127.83. What's wrong with this computer? Yeah, $127.83. You're getting this? You're getting stuff? You need to. We shall be discussing n number of examples in the upcoming time. Just understand this, that the transaction price is allocated on the basis of standalone price. Okay. And now what's the fourth point? Revenue. You recognize the revenue when when you satisfy the performance obligation. So this computer, when it gets sold, when it gets handed over, point in time, you shall recognize the performance obligation allocated to computer then and there. But then this technical support is getting delivered on monthly basis. This is over time. So with every passing month, you shall be recognizing a part of that month as a revenue. All right, because you are satisfying the performance obligation. You are fulfilling your promise on monthly basis. Like simple as that. If there are 12 months, let's just say 12 months. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay. So the technical support is for $120 for entire 12 months period. So for after passing of every month, $10, $10, $10, $10, right? For every particular month, as soon as a month pass, you satisfy your performance obligation to an extent, partially. You shall be recognizing that. All right. Now we shall be going through the actual answer. Now see, you will understand how do you write an answer. What's the first point? C stands for contract. Identify the contract. Okay, we identified the contract. The contract is between Wade and its customer for provision of goods and service both. All right. What's a good here? Computer. What's a service here? All right. So service here is the technical arrangement. Now we are going to step number 2. Which is P. P stands for performance obligation, which says identify the separate performance obligation. Now, what are the two performance obligations? Even here the word used is promise. All right, supply of computer and supply of technical support. Transaction price is $4.20. How do you allocate this? How do you allocate this? You allocate this on the basis of standalone selling price. Now, that could have been anything. For the sake of understanding, for the easier calculation, the total given right now here is $420 in itself, so that it becomes easier for you to divide that, to do the calculation. But in the upcoming sums, it won't be same. In general life, it's always higher. Okay, sir. 5th point is recognize the revenue. Now, when do you recognize the revenue? For computer, since the promise is getting fulfilled at the point in time when you are handing over the computer, so the transaction price allocated to computer gets recognized in your books of accounts right on 1st December 2011. All right, right on 1st December 2011, at that very day. But then the technical support stuff, it is for 12 months, and since the books are getting closed on 31st of December 2011, whatever the period is, 2011, so you shall be recognizing revenue only for this particular month, because here the promise is getting fulfilled with passage of time or over time, with passage of time or over time, over the period of time. All right, so it gets recognized partially with the passage of time on the basis of contract. Now here contract is on monthly basis, so we are recognizing it on monthly basis. Had the contract been on quarterly basis, we shall be recognizing in our books on quarterly basis, on the basis of facts given in question. That's how you recognize the revenue when the performance obligation is getting satisfied over time, over the passage of time. Okay, I hope the concept is clear here. Now after this example, now they are discussing, which we shall be discussing as well, all the 5 points in detail. Now though we have discussed them in much more detail, but then we shall be going through it as well. Okay, all right, sir. Okay, like let me start this with the separate session, the discussion. Now, though the session is getting ended here, but then start watching the next session just after this. Like, don't take a very big break. Watch them in continuation. Okay. All right. See you soon in the next lecture. Come back fast. Have a drink of water. Go to the washroom. Relax in a 5 minutes, and come back soon.